In today's video, I want to bring you up to speed on the latest developments concerning the Federal Reserve and the U.S. central bankers, as their actions are set to impact all of us. Currently, they have orchestrated a complex economic scenario characterized by elevated interest rates, a situation that poses considerable challenges for the average American unless they belong to the upper echelons of wealth. Here's the scoop. The Federal Reserve is currently divided among its voting members, some leaning towards intensifying their measures, including the possibility of further interest rate hikes, while others are more cautious about this approach. I will update you on this, but before that, I want to share some important information with you. The economic outlook for the upcoming quarter, covering July through September, is quite remarkable. According to the Federal Reserve Atlanta, they're forecasting a significant annualized growth rate of 5.8% for the economy during this period. That's quite an impressive figure. And what's even more noteworthy is that they've revised this projection upwards from an initial estimate of 5.0%. So let's pause and really take in the implications of this information. They are making us believe that the current state of the economy seems to be on a remarkable upswing. And if you're not feeling like you're part of this economic surge, you might be missing the upswing. Why the Federal Reserve is indicating this? Think about it. If the GDP report indeed reflects a growth rate of 5.8%, it essentially gives the Federal Reserve the go-ahead to consider raising interest rates even further. We might be looking at rates surpassing the 6% mark. Now, let's address the concern about high interest rates. The risk associated with them is that they can nudge the economy towards a recession. However, if they make us believe that the economy currently thriving at a growth rate of 5.8%, it suggests that the economy could potentially handle even higher interest rates for an extended period. I hope this reasoning is clear. Moving on recently, at the end of July, they concluded a closed-door meeting of the FOMC, and the details of this meeting have been unveiled. In this session, the Federal Reserve collectively made a decision to enact a 0.25% increase in interest rates. This action has propelled the federal funds rate to 5.5%, reaching a peak not seen in over 2 decades. Interestingly, the minutes from the meeting have revealed that all 11 voting members of the Federal Reserve were in unanimous agreement regarding the interest rate hike. This unanimous stance underscores the notion that the Federal Reserve has more interest rate increases planned within this particular economic phase. In essence, there's a widely held belief that their course of action is far from being finalized. This detail is particularly noteworthy, and I feel compelled to draw your attention to a pivotal quote extracted from these minutes. Most of the participants still believe that there is a significant possibility of inflation increasing, which would mean that the central bank would need to implement stricter monetary policies. You confirm this by reading the meeting minutes. It's not only mentioned that there's a risk of inflation rising, but it's emphasized that this risk is quite substantial. This is crucial because although inflation has been decreasing somewhat, it's still well above the targeted 2%. It's worth noting that the CPI for overall inflation actually rose last month. The Federal Reserve is quite concerned about this. In fact, they're significantly worried that inflation might make a strong comeback. This is their main fear, and it's a big concern, especially considering what happened in the 1970s. They're keen on avoiding a repeat of that situation. Looking forward, the next FOMC meeting, which is scheduled for September 20th. The key question is whether they will decide to increase interest rates during that meeting. The truth is, the minutes released by the Federal Reserve didn't offer any clear hints about their intentions for September. The only indication was that their decision in September will be influenced by all of the new information they receive. This aligns with what Jerome Powell mentioned during the press conference in July, that their choices will depend on the data. So as I went through the detailed minutes, I wasn't surprised by the content since it echoed what's been said before. All right, so here's the plan moving forward. Until meeting on September 20th, take some time to consider what data is still outstanding. We're mainly waiting on the information for August, specifically regarding inflation and job figures. Once we have that data, we can analyze it to make a prediction about the Federal Reserve's actions on September 20th. As of today, the ComFWatch tool indicates the following probabilities: an 85% chance that the Fed won't increase interest rates, and a 15% chance that they will. Now let's dive into some quotes from the voting members of the Federal Reserve, which I believe are crucial. These quotes provide insight into their potential decisions for September 20th. We'll begin with the Doves, who lean toward a more lenient monetary policy. These members aren't keen on aggressively raising interest rates. They're in favor of more significant money printing. On the other hand, the Hawks advocate for a tighter monetary policy, which involves supporting higher interest rates and reducing money printing. Let's start with a quote from a Dove, Patrick Harker, the president of the Philadelphia Fed. On August 8th, Harker stated, and I quote, "Unless any unexpected data emerges before mid-September, I think we might be at a point where it's wise to be patient and maintain steady rates." Essentially, Harker is expressing that unless something surprising happens, he's inclined to hold off on raising interest rates. Shifting our attention to Neel Kashkari, the president of the Minneapolis Fed, known for his more cautious stance. On July 30th, Kashkari expressed that progress is being made and the course is being maintained. If the situation demands, they are open to further interest rate increases. In essence, Kashkari commends the Fed's efforts in curbing inflation and emphasizes their reliance on data for decision-making. Now, turning to a centrist perspective, a position between the dovish and hawkish views. John Williams, president of the New York Fed, commented on August 2nd about the ongoing debate regarding the necessity of another interest rate hike. From my interpretation, Williams suggests that we are nearing the peak of interest rates in this economic cycle. However, it does indicate that the Federal Reserve might consider a slight elevation in interest rates. Arguably, the most crucial viewpoint comes from Jerome Powell, the chair of the Federal Reserve. As a centrist, he mentioned that the possibility of raising rates again in September exists if the data supports it. Equally, Powell implied the option of maintaining the status quo at that meeting. These remarks were made during the July press conference, deliberately without giving away hints about their September actions, a strategic move to keep their choices open. Hey, let me share a quote with you from someone who holds a strong stance on economic matters. Michelle Bowman, who's a governor at the Federal Reserve, she expressed her thoughts on August 7th, mentioning that she anticipates the necessity for further interest rate hikes in order to bring down inflation to the desired 2% mark. So just to recap, during the July meeting, it's worth remembering that all the voting members of the Fed were in agreement when they decided to increase interest rates. However, things seem to be taking a different turn for the upcoming September meeting, with indications pointing towards a split among the voting members. That's how I'm seeing the situation shaping up for the September meeting. But I'm really interested in hearing your thoughts. Do let me know your take on what might unfold during the September meeting in the comments below. Now, shifting gears a bit, let's talk about the prevailing viewpoint regarding interest rates in this economic cycle. The general consensus among most folks is that we'll likely see interest rates reach their highest point somewhere between 5.5 to 6%. Currently, we're sitting at 5.5%, which might suggest that we've already reached the peak. It's important to keep this in mind, because if the Federal Reserve decides to push interest rates even higher, it's causing many to believe that they'll follow a pattern of raising rates every other meeting. This is the prevailing belief in terms of the frequency of rate hikes. Interestingly, Jerome Powell has a different perspective on this. He mentioned that they might opt for a different approach, potentially raising rates 2 out of every 3 meetings. As we approach the September 20th date, personally, I'm looking forward to gathering more clues from the exclusive economic event known as Jackson Hole. This is a gathering that includes central bankers, politicians, and influential individuals from the business world. Additionally, I'm eager to analyze the economic data from August. These factors combined should provide a clearer picture of what we might expect. If you've been keeping an eye on things like interest rate cuts and the shifts in the Federal Reserve strategies, you probably have a sense of where I stand on the matter. I'm not convinced that we're going to see any reductions in interest rates throughout 2023. Consider this your update for the day. I'll circle back to you with more information on the developments at Jackson Hole. Please subscribe. Thanks for watching, and until next time.